when we think about like why we do what we do, most people say, well, I want to help people. Well, do you really want to help people or just want to help rich people? That's kind of what's happening is the RIAs just have to keep going up market. Now it's the point where like there's big cheerleaders for this idea that, financial advisors should just abandon their entire business model and just go, retainer fee or bill on net worths or incomes and, which are all lovely theories, right? But, why are we having to make all of those decisions? And a lot of it's because, our businesses are incredibly inefficient.
Hey everyone, welcome to the Model FA podcast. Today's guest is Jason Wenk. Jason's a prolific entrepreneur. He's the founder of multiple companies, and his most recent technology venture is called Altruist, which we're going to learn a lot more about today. But I'm just super excited to have Jason on the show. He's someone that I've admired from afar for a number of years. I think he's one of the most prolific entrepreneurs in the space, and nobody really knows about him. So I'm excited to be hopefully one of the first people to really interview Jason and get a sense of what he's been working on, where he came from, and just some of the cool stuff that he's got in store for us. So Jason, thank you so much for coming on the show.
My pleasure. And I gotta say, man, you just nailed that opening. So not many people can just off the cuff be so endearing. But man, you're making me kind of blush here. So thanks for the very lovely intro, and it's a real pleasure and big fan of your work as well.
Thanks, brother. Yeah, it's just, I guess that's my superpower, is just like going and nailing those weird things on audio and video. So again, I just appreciate you coming on, man. And like I said, I feel like most advisors don't really know who you are. Like when you go to a conference and you say like Michael Kitz's, or you say Carl Richards, or any of these other guys, Josh Brown. And then you say Jason Wenk, and they're like, well, I know the other three, but I don't really know Jason. Like, who's Jason Wenk? And it's like, well, he's built like way more companies that are more valuable than every one of the other guys that I just mentioned. Like, why don't we know who this guy is? So why don't let's just get started. I don't usually do like the regular interview style podcast, just because I like to kind of focus on the meat of what people are working on and just their direct contributions, and help the audience apply their knowledge. But I think in this case, it would make sense just for the listeners to get an idea of like where you came from, how you think about things, and just some of the stuff that you've worked through and where you're at today. I think it's a cool story. So, and I'm hoping it's a cool story because I don't really know it, but I'm guessing it is. So why don't we start there, man? Like, let's not from maybe like birth to now, but just like maybe talk me through like your start in the financial services industry, and then we'll just kind of see where it goes.
Got it. Yeah, cool. So happy to share the story, and I think it is funny, to give you like a story before the story, as having dinner with an advisor this maybe a couple weeks ago, and he's fairly well known, we'll say, like in the FinTwit world, and lots of followers, and really, really lovely guy, like great human, just really become a friend, and I really enjoy kind of chatting and hanging out with him. But it was interesting, he kind of said to me, he knew that there's some conferences that I was going to be at. He saw I was going to speak at one, and he says, hey man, you nervous at all, to speak at a conference, and I kind of looked at him, I was like, nah, not really, man. Like, why do you ask? He's like, well, you've never spoke at a conference, have you, before? Yeah. So it was an interesting conversation. We had to kind of back this whole thing up. And I guess, my response was like, listen, I've only ever spoken at my own conferences. So I've never I don't really go on the conference, whatever, like at all, and just go and travel the world and speak at other people's stuff. But, so I'm happy, I guess, that I'm unknown and, outside of a very, very small community that knows my stuff well. So, I've been doing this for a long time, man. It's weird, super strange actually, that I'm 39 years old and I've almost been in the business 20 years. I started, when I was still in college, and but not like some people. Some people will be like, "Oh yeah, I started in college. I was like selling life insurance, door to door or something like that." I had a really unusual kind of entrance to business, but kind of a shortened version is I grew up in a very rural area in West Michigan, was quite, I didn't think of myself as poor, but we certainly weren't rich. We didn't have a ton, and had very, very hardworking blue collar family in a very hardworking blue collar area. I had, the good fortune of getting our first home computer in the mid 90s. And I just embraced sort of this idea that you could do things on a computer versus, having to go and swing hammers and, use wrenches and jackhammer, all that stuff. Right. So became sort of a self-taught, hacker, I guess is the best way to explain my engineering skills. But I learned how to do a lot of things, and it's served me very well. My entrance into the industry was writing productivity applications at a large wirehouse, led to eventually a full-time job. I moved to New York, was trained there, worked in Chicago for a while, and by the time I was 21, I was basically completely jaded and burnt out, and that was the last job I ever had. So I learned really quickly, I think kind of coming into the space more as an analyst or engineer, my way of doing things is quite pragmatic. I'm not, I wasn't like a natural salesperson or anything like that. I just was, good at math, I guess. And I could do things that, probably were, again, today engineers would look at it as being very, very rudimentary, but at the time, in the late 90s, early 2000s, there just weren't that many people building technology for wealth management. It just was, for those who weren't around back then, like Morningstar was still sending CD-ROMs. Like that's how you got your Morningstar reports.
Yeah, it's crazy.
It was a different world than we live in. So I kind of entered from that side, right? The tech kind of side of the industry. And then what I found was that, a lot of things didn't make sense to me. I didn't understand the way financial advice was delivered. I like the way that investments recommended, like all those things seemed really archaic. So I decided, I want to go out on my own. And my very first venture, people won't find it on LinkedIn, and it's kind of like the one I don't talk much about. But my very first venture was building an automated investment allocation platform. I wrote the code myself, even built the website, and just did everything myself. It was real ugly. But basically what it was designed to do was to get consumers. I thought, hey, why can't we just build something that will show people how they can allocate their 401ks, but not really as an advisor, right? Just as like a subscription service. They pay $40 or $50 a month. And again, there's a lot of stuff like that out there today that's really crappy. But
when was this? Is this like 2000s?
This is like a long time ago, man, like 2002, okay. 2003,
wow. Okay.
People were still dialing up, to get
this is like 56K modem style.
Yeah, it was the, the real wild west, right? But so what's cool is I learned a lot about marketing, because I built this product and I was like, I've got to figure out how to sell this thing. And so I was using AdWords and Overture and these different, it very much ages me, right? But I found I could acquire customers for a certain dollar amount. So I learned very early what CAC was, cost of acquisition. And then I knew what my lifetime value was. I get people to pay for a subscription service, auto billing them every month. And I knew how long on average they'd stick around for.
Yep.
And so I learned some very early business principles that it's ironic. Most financial advisors, I think today, still don't know. I think they're really just self-employed people that, do financial planning or whatever. But very few people are really, entrepreneurial. They don't know much about business necessarily. And so again, I would never have said I was a business person, but that's how I got into the space. And then from there, it was I just kept thinking there kept being bigger problems, right? So I would notice that business, was actually very lovely. It was like a cool business, super low maintenance, made nice monthly cash flow. But it wasn't really helping people is kind of what I discovered. And the LTV would suggest that people would cancel their subscriptions before they would have had it long enough to really get enough benefits. Even though it made money for me, it didn't really help people in a meaningful way. And that's what led me to go into being a financial advisor, sort of learning that part of the business. And
how old were you?
It was a real challenge.
How old were you when you started the advisory side?
So I started I first joined an independent broker dealer. I was probably 23,
Okay.
So, and then I started my first RIA when I was 24.
Wow.
So it's funny nowadays, there are a number of younger advisors, but yeah, I've been an RIA only for 15 years, and it started fairly young. And that was a business that today is known as Retirement Wealth Advisors, a wealth management firm, sort of platform. There was a lot of interesting things learned over that, which led into other businesses. But yeah, man, it's been a long, winding road to get here, but that's how it all started.
Nice. I've noticed you've done some really cool stuff over the years, like building your wealth management firm. I mean, one thing that I saw just doing some summary level research was the annuity reviews that you would do, like through, I think it was called like Annuity Gator or something like that. And it was brilliant because you got this army of these insurance professionals that are just, sponsored by the insurance companies, and the insurance companies are spending millions of dollars on marketing, trying to drive their sales force to like sell more Allianz 222. And you, I think, I mean, correct me if I'm wrong, but it seemed like you created these long form videos and like explanations on how people should go about selecting and thinking about these annuities. And they were like very in depth. And I think it looked like it drove like a lot of traffic to your RIA and allowed you to kind of grow and scale. Can you like talk me through one, if I'm going down the wrong path here, because I don't know if that's true, but and two, like what did you do to grow the RIA? Because like age 25, starting your own RIA 15 years ago, like that's not really a thing. Like not many people did that. So I'm curious to see like what mechanisms did you use for growth?
Yeah. So I'll start by just saying, like, in the first couple of years, I used some offline marketing. I got pretty good at that too. So back in those days, you could very effectively, sort of cost effectively and time effectively do seminars, in person, like face-to-face stuff. So I did some of that, did really well with it for, probably 2 to 3 years. And built the RIA. I think it took 4 years roughly to get it to 100 million in assets. And I kind of did that, like I'd call it the old fashioned way. I I knew my numbers and,
activity,
and just was really religious about, executing. Right. So that was kind of that, but what I quickly kind of like realized like that a lot of those things don't scale. And I really was ambitious I wanted to impact more people. Right? I want to be able to help more people. And what I find is that a lot of the best advisors, I think like you, Patrick, like I talk to a lot of financial advisors, financial planners. And it's really a shame, when I meet the really good ones, there's been a handful I've met over the years where like I personally would hire them because I just feel like, wow, these are the type of people that they really get it. Their service is awesome. Like what they do is so helpful. But most of those advisors, there'll come a point when they hit a capacity. So if they're practicing, right, like they can only serve so many people. And then eventually, if they want to go beyond that, they have to sort of shift into becoming a business owner. And in many ways, they then struggle because a lot of times the best, like real tactical, like advice givers aren't always the best at managing people and enterprises. So what I found, like in my case, I felt like, okay, I was a pretty good advisor and I really cared about people, but I wanted to be able to help more people. So I wanted to scale that digitally and start doing all relationships virtually. And I was very early to that game. So this is like 2000, probably 8,
Wow.
2008
Yeah,
through
that's
2012.
really early for that.
And no one was doing it. So today it's funny, right? When we hear about like the prolific content creators today, and no disrespect to all those people, because I feel like they're probably doing meaningful and helpful work. But very, very few have ever figured out how to turn that into actual business in a meaningful way. So it shouldn't take 1 million social followers to do like, 100 million a year of business. Like I don't think I've ever had more than 1,000 social followers in my life, but I've had many years doing over $100 million. So what I learned very early on was that you could create content for the hell of it, or just as a popularity contest or whatever. But I wasn't really interested in that. And again, these are reasons why like I flew so under the radar, because what I found was that I wanted to create content that got people to take action. Right. So like, Annuity Gator, you did a really good job, by the way, of explaining it. I started it originally just on my own blog, jasonwenk.com. And started doing, among other things, annuity reviews. what's interesting, right? As you think about reviews, you've got companies like Yelp today, multi-billion-dollar companies, and what's made them kind of what they are reviews. You look at Amazon, a big part of like their marketplace, what made them what they are reviews.
Yep.
So the thought process is pretty simple. It's just like, what if I knew what people were curious about, learning more with their money, very detailed, it's a very long tail, which just means like, I wouldn't like, whenever I see advisors, they do this, and again, I applaud them for their effort, but I try to coach them a little bit and say,
yeah,
you don't need to be highly ranked for the term financial advisor, because like, who cares? Like, that's not how people hire financial advisors, is typing that in. And people go, well, I want to be number one for, Los Angeles financial advisor. Be like, yeah, still, like, that's a total waste of your time. Like, don't do it. What I wanted to be number one for was when I knew somebody had like maybe $500,000 and they needed help with it. And so, yeah, like basically I was hijacking traffic. If you think about it, when someone's trying to sell you something, one of the first things we do, and this isn't like a new thing, this has been going on for, over a decade, is we go Google it, right? We go home and we type in like, is this product good, right? So the example I give people a lot is that if someone's shopping for a TV and they type in flat screen TV, it's wasteful. Don't ever try to bid on that or try to rank high for that. But if someone types in like Vizio 55-inch ultra high definition 4K smart TV, blah, 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 right? Very long and detail. And then they put in like price or best deal or reviews or whatever, right?
Buying
That's
intent.
someone who's like really close to making a decision, and they're looking for either like affirmation or allaying their fears, right? Like, that's what they're there for. So yeah, we started creating these, I started writing these reviews, and just took a very analytical approach to it, created like 50+ minute videos where I would walk through the testing, because I wanted people to feel like they could trust the content. It was real. Like, I'd spend 2-3 hours kind of researching and building and modeling out the crediting methods and all the riders, and reading the disclosure documents for the various products and kind of translating it into English. And so what was crazy is like, I could write a post, like you mentioned Allianz 222. You think about Allianz is a huge company, right? But I think I actually ranked higher than them for many years. Maybe still do to this day. I don't know. And so when people were looking for information about those products, like, they would find my site, right? And I would talk about, hey, look, there's good and bad. And, and when you're the first to do something today, there's probably a bunch of copycat things.
Oh yeah. Yeah.
Trying to do that.
It's a boneyard now.
Yeah, you're right. But what's cool is like, when I was doing it, it was life-changing. There was the quantity of people that needed and wanted help was more than, a dozen people could have never kept up with them. It was so many people. And this was from writing like 2 or 3 blog posts. So it was definitely a springboard. It really changed the velocity of the firm. And all of a sudden, we were doing 2 million a month and 4 million a month and 5 million a month. And it was all free. And it was all virtual, right? I mean, there was no office. And what's odd, right, is that was, again, a decade ago. And so, yeah, so I'm really proud of some of those things. I mean, since then, I've given that website away. So, for those who don't know me well, I guess you said I was a great entrepreneur. Good entrepreneurs aren't always great, I guess at managing their personal wealth. They're great at building stuff, right? But I got tired of it, actually. It became something where I felt like, there was other things that I wanted to do. I didn't want to be known as the annuity review guy type of thing.
Yeah.
I felt like it was a really worthwhile venture. And so I gave it to 2 friends of mine for nothing. So I didn't sell it. Today, to my knowledge, that website still drives over $100 million a year of business. I probably should have sold it for a few $1 million or something, but so I gave it away to free up time to pursue other projects.
Wow, man. Yeah, I mean, when I first stumbled across you years ago, this is prior to Altruist and some of the other things that you've done. The first thing I found out was the annuity strategy, and it's probably the most brilliant strategy that has ever been done, honestly, in the wealth management space, because you've got multi-millions on the backs of insurance companies being spent on advertising. So they're essentially like a free, paid advertising channel for you. And then you've got a sales force that is going out and, creating curiosity and building relationships, but they can't build trust because they're product salespeople. So you essentially have a free marketing budget, a free sales force, and then you have an interested customer who's already been somewhat educated on the benefits. And then all you're doing is just bridging the gap between where they're at from a pain problem standpoint to trust and, giving them a solution. So yeah, I think that's awesome. So that springboarded you in the RIA. I know that you have lots of advisors now that are part of RWA. Was that the primary feeder mechanism for kind of scaling that up and getting all the other advisors to join RWA, or like where did you go from there?
Yeah, so I took 2 years kind of off, I was pretty burnt out. I was, in my late 20s still, but I'd been, kind of going pretty hard for working hard, just for a few years. And so I thought, I'm going to take a couple years and just kind of work part-time and enjoy my kids so I took a couple of years, basically. Nice. Kind of very below the radar. And I had a really nice, kind of book of business. All my clients were virtual, so I could kind of go work and do what I wanted whenever, and very much, work part-time. But what I found was that I started getting kind of bored. I wanted to be productive, and I felt like I had a lot of gas left in the tank. I just needed that little recharge. And that was the last time I ever really took a recharge. Right. So, but it was really cool to be able to do that. And it sort of spurred the next venture, which, Retirement Wealth definitely grew. It still was growing while I was kind of, only partially sort of, running it. But what happened was kind of strange. I speak very little at conferences, and although I'm quite open, it's always funny. Sometimes an advisor will reach out to me and shoot me an email or whatever, LinkedIn or Twitter DM or something, and then I write them back, and they're like, "Oh, holy shit, I didn't expect you to do that." But I really do like to help and help other people and share. So I started getting more and more people kind of curious about my story, reaching out and how can I plug in? And at that time, we built, because my background really, again, was, I consider myself a quant. That's how I would have, described my job to people, as I built algorithms to do math on an automated basis. And so much the way that I broke down, in a very, kind of statistic-driven way, insurance products, a very sort of actuarial method of breaking them down. I did the same with investment portfolios. So when I was running Retirement Wealth, we had these, investment portfolios that were fairly automated, and we kind of developed a brand, that we called them formula folios. And so people were joining Retirement Wealth and using our portfolios and using our brand and marketing. It was a pretty, it's kind of like a turnkey platform before turnkey platforms were really a thing. Mm-hmm.
What year is this?
I'm sorry, say that again.
What year is this? How long ago was this?
Yes, this has been around 2010, 11 time period. Yep.
Got it.
So I turned 30 in 2010, and 2011 is when I formed Formula Folios as its own company. And kind of what we realized with that was when Retirement Wealth, it was a platform. Basically, people could become IARs and they could do all their business there, and but we weren't really. Wasn't really designed to serve like RIAs or other broker dealer reps and all these things. So we thought, well, let's just kind of spin off Formula Folios, make it into a TAMP, a true kind of proper independent TAMP that can work with like other advisors, and we'll build some marketing tools. And it sort of philosophically, the thought was this, right? If you go ask lots of advisors, and maybe you've already done this since you work with a lot of advisors, hey, what is your number one biggest problem? And so what we found is more often than not, their biggest pain point was, hey, I need more clients. If I could get in front of more people, I feel like I can do the rest really well. So we felt like, okay, we'd found some really smart ways to help fix that, pain point. But then if people aren't having that problem, or so if someone is, so the alternative, right? If like, hey, getting clients isn't really the issue, now what's your biggest pain point? It would be like, look, running my business, scaling my business, hiring people, like it's all the operational stuff, right? Sort of like scaling a business. And so we thought, let's just build a platform that really addresses those two problems. let's get you as many clients as you feel like you can handle. Let's help you operationally handle as many of those clients as you want, right? So, so you can build and really scale your business. And so Formula Flows was started legally in 2011, started working with advisors in 2012. And then I did that for 7 years, 6 years, I guess you could say, until 2018. And it was a really good run. We built a lot of really cool technology. We did this very under the radar. So, whatever there is today, I don't know, 1 million advisors, we only worked with a few hundred advisors. So it's not like it was like this mega network or anything. And really, there's probably only 100, 150 that were really what we call with us for more than a few years. The company was adding advisors so fast that like a few hundred is a bit of a misnomer. In the early days there was 10, then there was 50, and then there was 100, right? So really kind of scaled it up. It was a fun run. I felt like, again, solved some problems. We were able to expand a network, really built some cool automated digital marketing that helped advisors get in front of more people. And, the company grew to around 100 employees and a few billion in assets, and was growing very, 100 million or so a month. It was really going well, but I just started realizing hey, we're still barely scratching the surface, of what's possible. And on top of that, we're building all this on really dated infrastructure that's not good for advisors or for their clients. That's what led me to step down from Retirement Wealth and Formula Flows and launch another company, right? So kind of the path, at some point I'm going to be so old, I guess I won't be able to do this anymore. But every few years you have an epiphany that things should be better, and that you should go do something more meaningful. And I think, entrepreneurs, if they're leaving one company to go do another one, it's hopefully it's not because they're chasing money or fame or something like that, but it's because they're realizing that there's bigger problems to solve, and they're doing that more for their own internal legacy, the legacy of their family or something, not really the financial legacy they might leave. And that's certainly reward. The kind of phase of life I'm at, kind of that midlife where I want to go do really big, important things that the industry needs.
Cool. So if we back up a little bit, then I want to talk about Altruist and how you structured that and, what problems you're solving there. So with Formula Folios, I'm just curious on how you grew that so fast. If you're not cultivating a strong personal brand, you're not doing a lot of marketing to the advisor community to get them educated on the Formula Folios offer and the value proposition. What was the process for getting these advisors to use the TAMP, use all the infrastructure?
So I think it's just a few things. Similar to how I mentioned, the way Annuity Gator and other things like that work, right? Is pushing your message out in front of the wrong people might get you, again, a lot of fame or notoriety or public attention. It doesn't grow businesses. Right. So in marketing, it's this thing called message to market match. You only really want your message to reach the market that you want to respond to it. So for Formula Folios, a couple things we have to understand for anyone who's out there building a TAMP business is if you're building a TAMP, turnkey asset management platform, you're asking somebody. In our case, we were acting as the money manager. We were doing the financial planning. We were a fully outsourced solution. Right. So a fully outsourced solution means if someone wants to manage their own money, not a good fit. Somebody's with a large ensemble or team already, probably not a good fit. We think about the problems we're solving, right? Helping advisors grow. Who's that going to appeal to? Well, an advisor really wants to grow. So if somebody's already at $1 billion and they're just dealing with operational headaches, probably not a good fit, right? So we were very good at targeting the ideal advisor that we wanted to work with. And so our target market was it was kind of like the neglected. It was the people that weren't being that much paid attention to. So our target was an advisor that had, I'd say $5 to $50 million in assets, and they wanted to 10x their business. So we were, everybody should be able to in one sentence, be able to say, here's who I work with and here's what I do for them. Right. So ours was our mantra was, we work with advisors with $5 to $50 million that want to 10x their business, right? How do we do it? Two ways. One, we fill their calendar with more people in a really cost-efficient way through primarily digital marketing. And then we give them back office support, technology solutions that allow them to scale that thing up tenfold, right? So we were very good at knowing who our market was, and as a result, if you weren't in our market, you didn't know who we were.
Yeah.
So that's kind of how we operated.
Cool, man. So throughout these transitions, I mean, did you have any growing pains as you shifted from, because like it sounds like every couple of years you evolved. So you were, you know, Jason doing the the ones and twos on the technology side, and you evolved to the advisor side. You evolved to providing infrastructure, shared infrastructure services, TAMP services, marketing for advisors, and it sounds like now you've evolved more to the entrepreneurial, solve really big problems with tech in the financial services space. Like with evolution comes challenge, right? It makes some people uncomfortable. It makes the team feel like what's going on. Like what challenges did you face throughout these evolutions? Because I mean, having done this myself to a degree, like I know there's challenges. So like what things presented themselves, like growth opportunities for you, or like what did you see as you started to kind of move through these different entities?
Sure. Yeah. So obviously, when you look back, it doesn't seem like it was that hard. So, but there were many tough days, right? So one thing that's like interesting in my ventures, up until recently, I bootstrapped all of them, paid for them personally, and growing a company, from like zero in revenue to 50 million in revenue, and doing it in like 5 years or so. That's really hard, and it's not a person that does that. It's really a collection of people. And so, challenge along the way. Hiring great people is tough. If you've never done it before, it gets easier the more you do it. And I think a lot of advisors, they get fooled into hiring bottom up, when you're always better off hiring top down. In my experience, which in other words just means don't go hire somebody because you can get them for $12 an hour. Like go get somebody who's great and moves the needle and doesn't need a ton of oversight, and can actually add value versus like just require babysitting. But advisors don't typically work that way. And so there's like totally you use the term evolution, right? Like I would say nothing necessarily came easy, but I very much believed in what I was doing, and I think if anything, the sort of superpower I had was I could get other people to believe it too. And if you can do that, and you get the right collection of people all believing in something that's worthwhile, like you can overcome a lot of like headaches, and there's a ton of headaches in our industry, and I've dealt with probably most of them, as I suspect maybe you have too.
Yeah, man, for sure. Hey, Model FAs, I know that you're enjoying this episode. I wanted to talk to you about a program that we're releasing. It's called the Model FA Accelerator. It is an intensive experience where we're going to bring you to Austin. We're going to help you solve the biggest problems in your practice: how to pick a niche, how to build a consistent marketing strategy, a sales process that actually converts, and how to scale it all up. So if you're curious about that, go to www.modelfa.com/accelerator. Book your call, and we'll talk to you soon. I mean, usually what I notice with superpowers comes like one major blind spot. It's almost like, the Marvel movies, like they're really strong, but they're, susceptible to something. Like, have you noticed like you have one specific blind spot that you've been trying to hire other people to shore up? Like where do you feel like your major blind spot is?
Yeah. So I think, I've gotten pretty good at understanding, sort of my entrepreneurial weaknesses, which I think, anybody who's, thinking years ahead, is more of a macro thinker. They need some really, really good micro kind of task managers, great operations people. So if you can have a phenomenal COO that just is great at, sort of the minutia and execution, like that's super complimentary. But I'd say like my biggest weakness, candidly, is that, and this maybe sounds big headed, but I'm really nice. I'm nice to people. I root for people. I give my time away probably more than I should. And so there's some people out there in the world who will take advantage of that. Fortunately, my wife is the polar opposite. And actually her bullshit detector is like, on fleek. So she vets a lot of the bad actors out for me. But, I think anybody who, if you want to be that compassionate leader that people love to follow, it's a common weakness to be, easily taken advantage of. So having somebody to help you with that is really critical.
Cool, man. That makes sense based on how quickly you move. I mean, you've got to have some level of, leadership skills in order to advance and evolve that quickly. So it's pretty impressive that within 10 years, you've been able to get all the way through to the point where you're launching Altruist. And you said you bootstrapped everything, including Altruist?
Yeah. So up until this venture, right. So tackling, like the biggest problems in the RIA space are quite capital intensive. And so
Yep.
I've been very fortunate to have been able to raise money quite easily, fortunately too, once you've done a few successful ventures, you built some credibility, and investors are very eager, to work with you. So I have an awesome partner in Altruist. We're working with Venrock, which is the Rockefeller family's venture fund.
Nice.
And just really great. Our partner there is fantastic. Serves on our board, Nick Beim, and so just very, very supportive of sort of our mission, which is really, in the RIA custody space, and even really I would call like the major tech side of RIA business, which is like the largest sort of portfolio management software, is the really, really expensive stuff, so to speak. It's way overdue. For beyond evolution. It's like to the point where it needs like mass disruption of sorts, because the direct to consumer side is moving very quickly. And net advisors, we're all kind of neglected. It's funny, it's still where all the money's at, technically. Far larger amount of assets flowing to traditional RIAs than robos. I mean, but it's there's not very good tools, so consequently what's happened with the advisors is and this is like is tough. I suspect I'd be curious kind of your take on this, Patrick, but the because we have really bad technology and it's very inefficient to be a financial advisor, like we can only systematize things to a degree, and then we're really forced into some tough decisions if we want to scale a business. And one of those tough decisions is we have to start instituting minimums. And then we have to start raising those minimums. And for anyone who, no pun intended, but has like an altruistic bone in their body, when we think about like why we do what we do, most people say, well, I want to help people. Well, do you really want to help people or just want to help rich people? That's kind of what's happening, is the RIAs just keep going up market. And now it's the point where like there's big cheerleaders for this idea that, financial advisors should just abandon their entire business model and just go, retainer fee or bill on net worths or incomes, and, which are all lovely theories, right? But, why are we having to make all of those decisions? And a lot of it's because, our businesses are incredibly inefficient. And again, there's only so much that we can move the needle through, like smart processes and procedures. And, and in the end, someone has to like radically change the biggest sort of elephant in the room, which is like, why can't we open accounts digitally? Why does it take an hour to open accounts for a household? Like it should take 5 minutes, why do we have to buy external software? And these are like, there's actually great answers for all this stuff, right? And it's all greed, really, and it's very easy to document that it's greed. So, so this one, I needed somebody who had, an equal passion for disruption, and Venrock was really game for that.
Nice.
And so we were able to put together an awesome team. We've been cranking. It's been a lot of fun.
So do you think that's the primary barrier as far as scaling up and serving that lower end of the market? And lower end, not to be meant disrespectfully, but just the idea of people that have less assets and income and haven't traditionally been served by, call it a fee-only expert advisor, is opening accounts faster and just doing things quicker on the operational side? Because I feel like the primary issue is just the fact that there's only so much hours in a day, right? And a human being requires human attention. So obviously they're going to get some of that back if they can facilitate the opening of accounts and the operational scale. But like, what about for an advisor who's already got somebody at $20 an hour who's trained on TD Ameritrade? They can open up the accounts, and really their primary issue is just managing their own time and energy better so that they can meet with more people. Are you seeing that as the primary barrier in front of advisors to work with the smaller accounts, or what are your thoughts there?
Yeah, so I don't think it's just time, but certainly time's a big element. So, like, if we think about the economic model, right, of a traditional RIA. So I'd say one, the time it takes to take really good care of a client is really high. So some of it's like, the communication time, but the communication time is not crazy high, right? Like if you're doing great work and you've systematically done things well, like you might need to spend a couple of hours with a client. And so that means we should be able to engage, in hundreds of clients in a year, if that's all we had to do, right? But we have to do more than that, because really, again, taking care of a client also involves opening their accounts, dealing with like cashiering, like needs. It also means we should be reviewing their accounts from time to time, like reviewing their entire financial situation, trying to find opportunities to make improvements. That just, again, takes time. Are there opportunities to do tax loss harvesting? That takes time. Should clients, have they already contributed what they should to their retirement accounts? Well, that takes, right. So I can go on and on and on. And interestingly, beyond all those elements, paying that person $20 an hour, that's not cheap. That's $40,000+ a year. Once you factor in benefits and, taxes and da, da, da. So if I have to, pay somebody $40,000 to do these manual tasks, which still means they're manual, they're not like efficient. So there's going to be a lot of mistakes. And then me as the advisor do the higher value, non-administrative things. I have to spend twice as much time. So 2 hours, maybe it's 4 hours to properly do my job. I'm really limiting how much I can scale. So I think the challenge, like we've actually built a few algorithms that will help us justify, like, as an advisor, like what we shouldn't be doing. But I think it's very feasible. Like our kind of mission is, well, what if we could help advisors serve 5 times as many clients they do today and still work less? Like, in other words, they do a better job, serve 5 times as many people, and not take an additional hour of time. That's very doable, but it's not doable with today's technology infrastructure. But it's beyond account opening. It's also like rebalancing accounts and trading accounts and like all these things. And yeah, you can outsource that. Cool. Pay somebody 15, 20 basis points for it.
Yep.
Try to scale that up. It doesn't scale. Yeah, it's not future proof, right? So there's so many things we have to do there. And then for clients, the current model is really broken too. Part of why it's challenging to take smaller accounts is, let's say you're paying a portfolio accounting provider $50 a year, just to do the billing and reporting on all of your client accounts. Even if it's $20 a year, if somebody comes to you and has a $10,000 account, or worse yet, what if they only have, they're great long-term potential client, they've got $500 a month they can put away, right? There's just not good ways to do that, especially to do it under one roof. Like, today an advisor might have to outsource that small client to some like digital, Betterment for Advisors or something. And then a whole different, kind of, package they do for like middle tier clients. And then like a whole nother one they do for larger clients, right? That's not scalable. That's not very efficient either. So a better solution would be, what if you could have, no account minimums? It didn't really make a difference one way or the other. Again, onboarding a client was about 10, 15 minutes. Managing all of the intricate sort of money management decisions were almost entirely automated, but might take a few minutes a month of review. You start adding those things up, and then you start compressing the economics of it. Now you can really grow, and you don't have to pay somebody $20 an hour, because you could just get an actual advisor and double or triple the size of your business and do it at scale really efficiently if you wanted to, right? So today we're boxed into like decisions that really we accept because there are no alternatives, but they're not really like, these aren't optimal solutions, right? It's just like what we have available.
Yeah, no, I get it. I understand. So how does Altruist make money then? So it sounds like is it a free TAMP? So you're doing all the investment management and the trading and things, or is the advisor doing that? Is the platform doing that? Like how is revenue generated for the software and then the company so it can continue to operate?
Yeah, so it's not a TAMP at all, actually. It's so think of it as like an alternative to Schwab or Fidelity or TD Ameritrade. So it's just an alternative to your custodian. Theoretically, someone could run a TAMP on it if they wanted to. Or an advisor could just, sign up and, run their business on it. So in terms of like, the revenue model, so some, I guess a moment of education for those who aren't familiar, you might be, but not everybody will be. Your custodian is robbing you blind if they're charging you commissions or they're giving you, a list of commission-free ETFs to choose from, and you accept that as their solution. And so, and what I mean by that is like, if you look at like Schwab, they make less than 10% of their money on commission. So the commission is just there to make you or your clients believe that's how they actually generate revenue. Similarly with like, oh, hey, look, we've just added more commission-free ETFs. What that really should mean is we've just found more ETF companies willing to pay us rev share so that we can give them to you for commission-free. And, they have higher expense ratios, so they're actually worse for your clients, but don't mind that. Look at us. We've given you more commission-free ETFs. Those don't help clients. Again, it just, is more of a revenue generator. And similarly with things like whole shares, like why should people have to buy whole shares? Well, whole shares are pretty handy. So are commissions. If you want people to carry large amounts of cash in their accounts. So, Schwab in their last quarterly report showed that their average cash balance in a brokerage account was 16%, right? Their default sweep option pays, let's call it 10 basis points, and they're making 220 in credit spread. So that's an enormous amount of revenue. I want to say it was around 60% of their revenue is coming from the cash in people's accounts. So, as an advisor, like I think what we have to kind of understand is that that's just, we accept it because there's no alternatives. The alternative is that the sales reps at those custodians will say things to you like, hey, we can do asset-based pricing, but I don't know. They'll act like it's like literally, moving heaven and earth to give you it for like 10 or 15 basis points, when they realistically should be giving it for free. There should be zero charge. Everyone should have asset-based pricing. So they make money on payment for order flow. They make money on securities lending. It's it's a laundry list. Account closings, huge money maker for custodians, right? Client closes an account, boom, they hit them with $100 account closing fee. So there's just, it's a litany of things that they do. And somehow as advisors, we've just grown to accept it because they're all kind of the same. There's not a lot of options. So as a custodian, our investment platform will allow advisors to buy and sell any ETFs or equities they want, all commission free, all with fractional shares. There's a model trading engine, so it's very, very easy if someone wants to manage their own models, their own allocations of models, so like sleeve-based trading. They can set up autopilot type rebalancing. There's no fixed connection. There's no FTP uploads, none of that. That's like literally straight through processing built in. And it's very beautiful, right? It's very simple. Like the UI is simple and elegant. So there's a lot of things that we're doing in terms of like how we make money. We make money in some of the similar ways that brokers will make money, but we'll make less of it because we're not doing things like rev share, not doing silly commissions, not doing a lot of the things that are really, I think, very disingenuous practices that somehow we accept as being okay. And even little things like cash, right? We'll make some money in cash, we'll pay a higher yield than everyone else. Like there's things that we can do. And in our case, by building everything from scratch, having no really bad legacy infrastructure that's very hard to maintain, single, point APIs, like there's just a lot of bad things going on, like with traditional, old, dated kind of infrastructure.
Yeah.
That makes it to where they have to have a lot of employees to do a lot of manual things. And like most of that can be automated. So it's a very Robin Hood-like experience, but for advisors, where you can just very quickly and easily do what you need to do, manage your entire business and pay, nothing for most things. And there'll be a few things that people will have, like we will have account closing fees, we will have an IRA fee and things like that. But a lot of things like that we accept today as being okay will be eliminated. And then all the software is included too, right? Whole nother conversation, right? That we go down that rabbit hole. But the big software companies that are doing a lot of the portfolio accounting and portfolio management, advisors are like, well, how can you guys give that away for free? It's like, listen, man, your current custodian's giving it away for free too. They're just not giving it to you. They're soft dollaring all their biggest customers. And so, it's one of these things where, for them, it's beautiful. They don't have to build the software, maintain it. They create a competitive marketplace. Meanwhile, all the biggest firms are getting soft dollars to go pay those things. So the software companies, they're fat and happy, getting their payments directly from the custodians. Custodians are happy,
everybody's winning, and the RIA's clients are paying for all this. The RIAs are paying for all this through shit margins and bad, operations. So, there's so many things that need to be fixed. And again, we're just kind of scratching the surface of it to, now and this year, and then we'll continue to kind of iterate and evolve the platform. But
nice.
That's me getting excited about what we're doing. So sorry for filling you with like a really long-winded answer.
No. I feel like I asked you all these questions about what you were doing before, which I know is painful when you're an entrepreneur and you're on to the next thing and you're super passionate about it. So I appreciate you you sharing the first 30 minutes about kind of what got you to this point. But I can tell this definitely strikes a chord for you. So it sounds like to me, new age custodial model. You're stripping out some of the unnecessary features and things that the custodians like TD and Schwab and those have just come to accept as part of doing business. And I totally agree with the revenue sharing and the NTFs. And I saw that. I used to work at DFA and Vanguard, so I saw that on the other side of the table when companies would pay to be on the platform, and I'd be talking to custodians and broker dealers, and they're like, "Sorry, you can't come on our platform unless you're willing to write us a big check." And I'm like, "What the hell, man? Like, got pretty good funds. Like, why do we have to write you a check?" And they're like, "That's just how we do business. It's just cost of doing business." It's like, all right, well, that doesn't seem very fair to anybody, but sounds cool, guys. So fundamentally, I understand the model. I think it's cool. I think it's a good build, a big build. I mean, how long before you have this thing fully operational and let's say rolled out to thousands of advisors around the country? Is it like kind of a staged deployment, or where are you at with it?
Yeah, so started this company in September of 2018. We were in beta. It took us about 10 months to get to beta on some features. We're still working with FINRA and the SEC on the regulatory approvals. A lot of our backend engineering is in place. So like all of our microservices architecture for the nerds out there that listen to your podcast. So we built a really lean and mean cloud-based, microservices structure, which means like all API for everything structure, and really kind of elegant and rapidly expandable and secure. So a lot of that hard, heavy work is in place. And now it's really kind of like the home stretch to going from private beta to public beta to public release, which will probably happen. Somewhat dependent on the regulatory approvals, but I'm optimistic it'll happen in like the middle of Q4 2019.
Okay, well, it's coming up. It's right around the corner. Probably like 2 months from when this episode drops. So good stuff. Are you? So you're building this platform. You're going to have a number of advisors join. It sounds like you're not going to have a lot of friends. So so who are your friends? Who are your allies here? Because what I'm hearing is every single software provider, considering I'm assuming custodians, I don't know what margin a custodial platform runs, but I'm assuming based on their number of people that work for their companies and their expense accounts and all the stuff that I see at these stupid conferences, it's pretty good. You're making pretty good money doing this and disintermediating advisor custodial platforms. And you can turn around and you can reinvest in technology to make the advisor's life easier. And you're monetizing those relationships differently from the tech providers. So, I mean, are these guys going to be knocking on your door trying to kill you, or who is a friend of Jason Wenk and who is being exterminated from this new venture?
No, well, I mean, so I would say that it'll be very few enemies, and I like to think it'll be lots of friends. Right? There's hundreds of millions of people who need access to better financial advice, and we'll make it more accessible through humans. So if you're a human, you're a friend of mine, I guess, that cares about other humans. But what I would say is that, I think we've all given the incumbents plenty of time to do what's right. And at some point, if they're not willing to, then someone needs to sort of stand up to the silent bullies. They act like we're all their friends. They host these conferences and throw these parties and give us swag and all of these things. And actually, I've met many wonderful people that work for the companies themselves. But if they haven't done much to enhance the fairness of advice and the way that it can be distributed and the access of it to the people who really need it, then shame on them. It's totally fine by me if they're not happy with what we're up to. And for a lot of the fintech companies, some of the ones that made it, and they kind of got big, I think they may have just lost their way. Hopefully this serves as a reminder to them of really where technology should play in our industry. It shouldn't become like something where we get kind of jaded and sucked into the dark side of the way finance has been for I think many years. We have a huge list of advisors waiting for this to be done, right? So I think we're on to something. Sort of the beta launch, we had an expectation on it. We thought, well, if we could get 50 people interested that have $1 billion of assets, boy, that would be great. And I think we did that in under 4 minutes from the moment we opened the beta, and then far exceeded our goals by multiple orders of magnitude. So, and that was and again, I was all done just in a few days. So we I would say like advisors as a whole are very eager to have alternatives. They just didn't know that they existed because until now they really haven't. And I'm hopeful that the customers feel the same way. I think what advisors maybe don't realize is that, the custodians, if I was venturing a guess, it very much depends on the products that someone uses. But if someone's using like, a kind of a mix of like the commission-free ETFs and, some mutual funds, and then maybe some agency securities and some individual stocks, and has a 5% cash position, and right, like that's like their overall blend. Your custodian's probably earning 50 or more basis points off your business. And again, that's being paid for by somebody, right? And it's typically, again, it's being sort of by way of the advisor, essentially being paid for by your clients. If you can give your clients better outcomes, so not just lower prices, but if you can also automate, AI can be friendly enough to do a lot of the things that we should be doing for clients every day, but we just don't always have time to, or we don't have technology that really allows us to. We can give clients better advice, lower cost at scale. That creates happier people who want to refer you more business. It grows your business. It creates really desirable unit economics, and we can really transform, kind of the RIA space. It's already really good. There's so many good people who are here for the right reasons. We just have to give them better tools, I think, to get them at scale. And then hopefully, people like yourself that are, I've done a little bit of advisor coaching in my days. I understand you do a lot of that as well. We need better coaches to show advisors what's possible, and kind of how to get there. I think there's going to be plenty of room for friends. The good news is that I'm pretty, again, I've said the term reclusive. I shun myself in, months. And so I'd say that like, I don't care if I have a lot of friends, frankly, but I do want to make a difference that I feel proud of. And that's what I think we're trying to do here.
Cool, man. No, I can sense the passion. I think there's a good product market fit, I think, based on what the custodians have been doing for a while, especially with the rev share. And then, I'm in agreement on the tech vendors too. I mean, most of the performance management or portfolio reporting platforms, as you said, I mean, we run into those issues in our RIA. We bring in a friend of the family and it's like, man, I don't want to pay $50 a year to service this account, and you're just going to sit on the platform. So then it's it's an emotional conversation between the advisor and the back office, and our back office guy is always going to lean towards, let's not take this client on because it's not a profitable client for the firm. And then the advisor, who's going to be more relationship driven, is going to be like, well, this is like a friend of the family. It could be a good account in the future. And, it's frankly just a favor to people that I care about. And it's like those two things are kind of diametrically opposed. So I think if you can solve that problem, it makes at least for the enterprise firm, right? It makes that relationship between the mid and back office and the front office that much smoother. So those two things are in alignment, and just makes it easier to run a business. So I think you're doing cool stuff, man. I appreciate you coming on the show and sharing all that you have.
My pleasure, man. I mean, obviously, I think I did like 80% of the talking. I hope that's like, not out of the norm on your shows, but it's been fun. I've been having to hold in a lot of these stories for like the last year, because we've been just head down, man, just building and building. And really excited to kind of get the message out and hopefully help people. And I think, sort of separately, again, obviously I don't make this a commercial for the work that I do. But I'd say that, a huge thing that I hope happens, this is what kind of one of the most fun things to see happen is maybe there's somebody out there, some advisor that's, or even non-advisor, right, that's following your work. They take a listen to this and maybe they get inspired to go do something
meaningful. And then they start thinking about how can I do it at scale, and they challenge themselves to think entrepreneurially, and they start some type of movement, that you don't have to be famous to start. And I know nobody really knows who I am. Nobody really cares. And that's totally fine by me. But I do know that, tens of thousands, hundreds of thousands of lives could be changed for the better, because, I had an itch and I scratched it. I'm hoping that people will go, yeah, man, like anything's possible. If he can do it, I can do it. Right. And that's, I think, part and parcel, like really why it's fun to share these stories.
Yeah, man. No, absolutely. Totally happy to have you share your story on the podcast. I mean, I think an 80-20 is a better balance for a guy like you. You've done a lot of stuff in the past, I guess, 19 years since you've been in the industry. And absolutely, we need a lot more talented entrepreneurs that enter the personal finance space. They're few and far between. So excited to spread your message. Hopefully it inspires some people, as you said, and hopefully we can have you back on the show at some point in a future season, get a check-in to see how upset all the custodians are and how great Altruist is doing and just kind of revisit, man. So just appreciate you carving out the time and look forward to talking to you again soon, Jason.
Absolutely, man. Anytime.
All right. Talk to you soon.